When it comes to investing in mutual funds, one of the biggest mistakes people make is they chase returns. Most people just go to a platform, sort mutual fund based on last 1 year of returns and invest in the fund that is sitting on top of the table. But the problem is, just because a fund has performed well in the last 1-2 years, there's absolutely no guarantee that it will continue to outperform going forward because markets are cyclical. Different style works at different point in time and performance keeps rotating. That's why instead of just focusing on past return, it becomes far more important to understand things like what is the investment style of the fund manager, how does the fund behave across cycles, and what kind of decisions they take during difficult phases. Then of course, I look at the portfolio construct of fund houses that gives a good idea about their approach. Now, I have mentioned this in the past as well. I personally admire the investment style of Rajiv Thakkar, who manages Parag Parikh FlexiCap Fund under Parag Parikh Mutual Fund. Apart from that, most investors are already familiar with large established fund houses like HDFC Mutual Fund, Kotak Mutual Fund, SBI Mutual Fund. These fund houses have a long track record and have gone through multiple cycles. But in today's video, I want to shift the focus slightly. I want to discuss 3 relatively new fund houses that have been set up in recent years. Now obviously, these fund houses don't have a long institutional track record yet. But interestingly, the founders behind these funds bring decades of experience in investing and wealth creation. So the idea here is not to say that these funds will outperform, but to understand who these fund managers are, what their investment philosophy is, and why these funds are worth tracking going forward. Personally, I find them quite promising. Alright, let's look at each of these funds. The first fund that I want to discuss is Helios FlexiCap Fund. Now before we jump into the fund itself, let's first understand the background. So Helios Mutual Fund received its mutual fund license in 2023. So as a fund house, it is still in its early phase. But what makes Helios interesting is not the age of the fund house. It is the person behind it. The fund is led by Samir Arora. He has been managing wealth for more than 3 decades. Before starting Helios, he was the founder of Helios Capital, which managed offshore funds investing in India and other emerging markets. Before that, he was associated with Alliance Capital, where he managed large portfolios. So he has seen multiple cycles, bull market, bear market, global crisis, and has managed money across different geographies. Now coming to Helios FlexiCap Fund itself, since this is FlexiCap Fund, it has the flexibility to invest across large cap, mid cap and small cap stocks depending on where the opportunity lies. This fund was launched in November 23 at NAV of 10. Currently it has an NAV of around 15. It has an AUM of around 6,700 crore with expense ratio of around 0.52. Now there's an interesting comparison of Helios FlexiCap versus Parag Parikh FlexiCap. Since Helios FlexiCap is new fund, we can only compare last 1 year of data. Interestingly, in this period, Helios FlexiCap has outperformed Parag Parikh FlexiCap by a big margin. Well, let me clarify again that last 1 year of outperformance does not guarantee that Helios FlexiCap can continue to outperform. Also, point-to-point return is not a right way to compare. But what I like about Helios FlexiCap is the portfolio construct. It has got around 14% exposure in banks, followed with 9.5% in capital market and 8.5% in finance. Its top holding include Adani Port, HDFC Bank, Eternal, ICICI, Reliance Industry, SBI, Bharti Airtel and so on. So yes, there's a strong large cap base, but this is not a typical index hugging portfolio because along with these, this fund has added names like PB Fintech, Delivery, Car Trade, 197 Communication. That tells you one thing clearly. This fund is comfortable mixing stability with high risk, high reward bets. Also the fact that there's a clear overweight towards financials. But it's not just large cap banks. It also includes strong NBFCs like Bajaj Finance, Shriram Finance, Cholamandalam and Muthoot Finance. It also includes housing finance companies as well as capital market and wealth management companies that are high growth but comes at the cost of cyclicity. Then this fund has strong consumption play companies as well. Along with that, this fund has good exposure in manufacturing and capex cycle with names like L&T, Cummins India, ABB, Hitachi, Siemens Energy, Bharat Electronics. Also, instead of avoiding loss-making or new age companies like many traditional fund managers, this fund has selectively allocated capital here. And finally, it has got healthcare plus pharma as defensive balance. If you look at this portfolio carefully, it tells you one thing. it is trying to participate in India's growth from multiple angles, while still keeping a strong large cap base. By the way, some of you might have an aggressive investment style for long term and might be interested in small cap funds. So Helios also has recently started a small cap mutual fund. Currently its NAV is around 10. Again, similar level when it was launched last year in November, but the reason for muted performance is due to underperformance of Indian equity market. But again, if you look at the portfolio construct, I find it very impressive. Of course, only time will tell how well this fund performs in the future. But I like the portfolio construct and investment style of Helios Small Cap Fund. Now, in case you already have a mutual fund portfolio and want to know its performance, you can review your mutual fund portfolio with Angel One. Simply import the funds and you can find a detailed portfolio analysis showing net XIRR return, overall portfolio performance versus benchmark, whether your portfolio is outperforming or underperforming the benchmark in rupee term. In fact, you can see each fund performance versus benchmark and which funds are outperforming and which funds are underperforming. Now the second fund house that I want to discuss is Abakkus. Again, just like Helios, this is also a relatively new mutual fund house. But the person behind this, Sunil Singhania, is someone with a very strong track record. He was earlier associated with Reliance Mutual Fund, where he spent close to 2 decades and managed some of the largest equity funds in the country. So again, just like in Helios, while the fund house is new, the experience behind it is not new at all. So the fund I am finding interesting is Abakkus FlexiCap Fund. It got launched very recently in January 26 at NAV of 10 and today it is at similar NAV due to volatile market. It has an AUM of around 4,000 crore and expense ratio of around 0.53. Now if you look at Abakkus FlexiCap Fund portfolio construct, at first glance, this portfolio may look like a typical FlexiCap fund because it holds large names like SDFC, Reliance, ICICI, State Bank of India, but they act more like anchors for stability. The real alpha is expected from broader set of mid-cap and niche name sitting below this layer. Then industrial and capex theme is very strong in this portfolio. You have exposure to L&T along with mid-cap plays like CG Power, BEML, Kirloskar, Cyient, Avalon Technology. This shows a clear conviction on India's manufacturing and capex upcycle, especially through mid-cap industries where growth can be sharper. Then there's selective exposure to new age and platform business like PB Fintech, Urban Company and Fractal Analytics. But allocations are controlled. The approach is to participate without taking excessive risk. Overall, Abakkus FlexiCap Fund is not a fund trying to play safe. It is trying to capture growth early, take calculated sectoral bet and generate alpha through strong stock picking. Of course, it is very early to conclude anything as the fund has recently been launched, but worth tracking closely. Also, for those who like to take aggressive bets and looking for small cap funds, Abakkus also has launched its small cap fund. This fund was launched very recently. At the moment, this fund has massive exposure in the debt category that shows that fund manager is probably not yet convinced of valuation in small cap and willing to wait for better valuation. But the remaining equity picks are very interesting. Then third mutual fund in the list is Old Bridge Focused Equity Fund. This fund is quite different from what we discussed in Helios and Abakkus. While those funds are relatively diversified and play across multiple themes, Old Bridge follows a very concentrated, high conviction approach. By mandate, a focused fund can hold a maximum of 30 stocks, and this fund typically operates with a tight portfolio of around 20-25 stocks. So every position matters here. The fund is managed by Kenneth Andrade. His career span over 30 years, during which he has built a reputation for a disciplined, contrarian and capital efficiency focused investment style. Andrade held various roles at firms like Kotak Mahindra Asset Management, Sher Khan and Apple Asset Management. Then he joined IDFC Asset Management between 2005 to 15 as CIO. From 2008 to 15, IDFC Mutual Fund ranked as the fastest growing mutual fund in India. Firm's flagship fund, IDFC Premier Equity Fund, delivered a CAGR growth of 22.3% over the 10-year period. After leaving IDFC, he founded Old Bridge Capital Management, an India-based portfolio management service. He recently transitioned back into the mutual fund space with launch of Old Bridge Mutual Fund, which received SEBI approval in late 2023. Since it's been only 2 years for the fund, it's too early to look at the return. This fund has an AUM of around 2,900 crore with expense ratio of around 0.97. If you look at the portfolio construct, the first observation is this fund has 14% allocation in traps, which is cash equivalent. It tells you that fund manager is not fully comfortable deploying capital at current valuation. That shows this fund is valuation conscious, not momentum driven. Second observation is the portfolio has exposure to Shriram Finance, Axis Bank, but notably avoid heavy allocation to typical large cap leaders like HDFC Bank or ICICI Bank. Next, there's a clear allocation towards metal through Tata Steel, Hindustan Zinc and Hindalco Industry. This indicates a strong conviction on commodity cycle. These businesses tend to deliver very strong earning in upcycle but can also see sharp profit decline when the cycle turns, making this a high beta but potentially high reward strategy. Then instead of betting on a single pharma company, this portfolio includes multiple names like Aurobindo Pharma, Granules India and Helios Life Sciences. This suggests a broader bet on pharma sector recovery, possibly driven by improving US generic pricing and margin normalization. Then consumption exposure is present but very selective through names like Maruti and Radico Khaitan. Then stocks like Kaveri Seed Company, Antony Waste Holding and MediAssist Healthcare are not widely owned or tracked. These are niche ideas where the fund manager is trying to generate alpha through differentiated stock selection rather than consensus trade. Overall, this is not a defensive or benchmark hugging portfolio. It is designed to generate alpha through concentrated high conviction bets across cycle. Compared to other funds, this approach can deliver superior return in the right environment, but it will always come with higher volatility and sharper drawdown. So if you step back and look at all three fund houses, Helios, Abakkus and Old Bridge, one thing becomes very clear. These are not funds that are trying to play the safe benchmark hugging game. Each one has a distinct investment philosophy backed by fund managers who have already seen multiple market cycles. In Helios, you see a balanced but slightly aggressive approach where a strong large cap base is combined with selective high growth bet. In Abakkus, the focus is more on capturing growth through early mid cap and sectoral themes, with a clear tilt towards India's manufacturing and financialization story. And in Old Bridge, the approach is very different. It is far more concentrated, valuation driven and contrarian, where the fund manager is willing to hold cash and wait rather than chase expensive opportunities. So the key takeaway here is not which fund will outperform in the next 1 year, because honestly, nobody knows that. The real idea is to understand how these funds are positioned, how they think about risk, and whether their style aligns with your own investment mindset or not. Because at the end of the day, mutual fund investing is not just about returns. It's about consistency, discipline, and ability to stay invested across cycles. And that only happens when you truly understand what you own. So instead of chasing the top performing fund every year, maybe it's worth spending a little bit more time understanding the people managing your money. That's it from my side. Let me know which of these fund houses do you find most interesting. And also, if you find this video useful, do share it with someone who simply buy mutual fund on basis of last 1 year of return, so that next time they can focus on factors that matters more in long-term investing. I'll see you next video. Till then, take care.